Let's explore divergence. You already know that divergence can signal a potential shift in momentum, but today, we'll look deeper. We'll explore why divergence is best used as a supporting tool rather than a primary trigger, and how combining it with other indicators can lead to smarter, more reliable trade decisions. Let's check your knowledge. Divergence happens when the price and an indicator move in the same direction, confirming the strength of the trend. Divergence occurs when the price and an indicator move in opposite directions, which may signal a potential reversal or shift in momentum. Now that you recall what divergence is, let's look at the two most common types. Bullish divergence happens when price makes lower lows but the indicator makes higher lows, suggesting that selling pressure is weakening. Bearish divergence is the opposite. Price makes higher highs while the indicator makes lower highs, hinting that buying momentum is slowing down. Divergence signals that a trend may be losing strength. It's an early clue, not a guarantee. Smart traders don't act on it alone. They wait for confirmation from support resistance, trend lines, candlestick patterns, or volume before making a move. How do they get confirmation? They study candlestick patterns. Reversal signals like a doji, hammer, or engulfing candle near the divergence area give traders extra confidence that a shift in direction could be forming. They also check support and resistance levels. If divergence occurs near a key support, for bullish divergence or resistance, for bearish divergence, it adds weight to the setup because the price is reacting at a meaningful level on the chart. Finally, traders watch volume. A spike in volume during a breakout or confirming candle adds strength to the signal. It suggests that more participants are entering the market, helping to validate the direction implied by divergence and increasing confidence in the move. In case of confirmation in a bullish divergence, traders might enter a buy position. To manage risk, they place a stop loss, 1, just below the most recent swing low, the lowest point of the last downward move. This way, if the price continues to drop instead of reversing, the loss is limited. If bearish divergence is confirmed, traders may enter a sell position. To manage risk, they place a stop loss, 1, just above the most recent swing high, which is the highest point of the last upward move. This helps limit losses if the price unexpectedly continues rising. Let's practice. You're analyzing this weekly chart. Price made a higher high, but RSI formed a lower high. Quiz: what would be the most cautious approach in this situation? Explanation: exactly. Divergence is supporting evidence of weakening momentum. It doesn't give a trade signal on its own. Wait for price action to confirm your setup before entering. Now you've seen how divergence can signal a shift in momentum and why it's best used as a supporting tool. Next, you'll learn how both RSI and MACD reveal different types of divergence and how to apply them with even more precision. Let's explore regular and hidden divergence. In this lesson, You'll learn more about regular and hidden divergence, and how they help traders spot either a potential reversal or a continuation of the trend. We'll explore how to identify them using RSI and MACD. By the end of this lesson, you'll be confidently reading momentum shifts and trend strength. Select the match. Regular versus hidden divergence. We'd previously discussed regular and hidden divergence. Can you match each type with what it signals? Signals a possible reversal. Hidden divergence signals trend continuation. Regular divergence. Stock? Excellent. Don't forget that regular divergence 1. Signals a possible trend reversal. It shows that momentum is weakening, and a change in direction could be coming. But hidden divergence 2 suggests the existing trend is still strong, even if the price is pulling back. RSI and MACD are convenient for spotting hidden divergence because they both measure momentum, the strength behind price movement. RSI is sensitive to overbought and oversold conditions, making it effective at highlighting when a pullback is weakening. Hidden divergence usually appears during a pullback or correction within an ongoing trend. It helps traders spot opportunities to rejoin a trend, not escape it. Understanding it helps you decide whether to expect a reversal or trust the continuation. In a bullish hidden divergence, the price makes higher lows, while the indicator makes lower lows, suggesting that price is gaining strength and the trend is likely to continue upwards. When traders notice bullish hidden divergence, they understand that the current uptrend is likely to continue. They don't enter immediately. Instead, they look for a signal, such as a bounce from a trend line or support level, or the appearance of a bullish candlestick pattern. Once the setup is confirmed, they enter a buy trade, placing a stop loss just below the recent higher low to manage risk. Their take-profit target is often set at the next resistance level or based on a favorable risk-reward ratio. In a bearish hidden divergence, price makes lower highs, but the indicator shows higher highs, signaling that the downtrend is likely to resume. In the case of bearish hidden divergence, traders interpret it as an indication that the existing downtrend is likely to resume after a short-term upward correction. They wait for confirmation, such as a rejection from a resistance level or a bearish candlestick formation, before entering a sell trade. To protect their position, they place a stop loss above the recent lower high and aim to take profit near the next support level or according to a predefined risk-reward setup. Hidden divergence helps traders stay aligned with the dominant trend while executing more effective timing of an entry. Can you spot the divergence type? Look at the chart carefully. The price is making higher lows, while the indicator is making lower lows. Quiz: what kind of divergence is shown in this chart? Explanation: oops, price is making higher lows. Uptrend continues, while the indicator is making lower lows. This setup confirms hidden bullish divergence, which signals trend continuation upward. Practice making decisions with RSI. You're looking at a chart showing price making higher lows, while RSI is making lower lows. Quiz: what does this setup suggest, and how would you respond? Explanation: incorrect. This is a case of hidden bullish divergence, which signals potential trend continuation. If confirmed by bullish price action, it's an opportunity to rejoin the uptrend. On the other hand, MACD, with its moving averages and histogram, shows momentum shifts and trend strength more smoothly over time. Together, they help traders see when momentum supports a trend, even if price appears to stall, making them especially useful for confirming trend continuation setups. Excellent job! You've learned how to recognize both regular and hidden divergence using RSI and MACD, and how to respond based on trend strength and momentum. Up next, we'll explore how divergence can improve your risk management. How to manage risks with divergence. In this lesson, you'll learn how divergence goes beyond spotting entries. It's a powerful tool for managing risk. By the end, you'll know how traders use it to place strategic stop losses, time their exits more effectively, and better understand the market context. Let's start with regular divergence. It signals weakening momentum but isn't a trade setup on its own. In the case of a regular bullish divergence, traders wait for confirmation, such as a bullish candlestick or a break above resistance, before entering a buy order. Traders place a stop loss, 1, just below the recent swing low to limit losses if the reversal fails. They go long, 2, after confirmation, and aim for take profit, 3, at the next resistance level, usually using a 1 to risk-reward ratio to ensure the potential profit is twice the risk. A 1 to risk-reward ratio means risking 1 unit to gain 2. For example, if the stop loss, 1, is 50 pips below the entry, the take profit, 2, would be 100 pips above. This ensures that even with some losing trades, consistent risk-reward planning can still lead to long-term profitability. In regular bearish divergence, traders confirm through a bearish pattern or a support break before entering a sell trade. A stop loss, 1, is set just above the recent swing high, the short entry is made, 2, and the take profit, 3, is placed near the next support level, targeting a 1 to risk reward. Select the match stop loss and trade action to each setup. You're comparing regular bullish and bearish divergence. Can you match each scenario with the correct stop loss and trade action? Buy after confirmation, bullish divergence, below the recent swing low, bullish stop loss, sell after confirmation, bearish divergence, stock. In hidden bullish divergence, traders wait for confirmation before entering long. A stop loss, 1, is just below the recent high or low, because breaking that level would violate the uptrend structure. A take profit, 2, is set at the next resistance or with a 1 to risk reward. In hidden bearish divergence, traders wait for confirmation, like a resistance rejection or bearish candle, before entering a short trade. They place a stop loss, 1, above the recent lower high and set a take profit, 2 near the next support, often using a 1 to risk-reward ratio. A quick check. You've spotted hidden bullish divergence on the chart. After confirmation from a bullish candle, you decide to enter a long trade. Quiz. Look at the 5 points marked on the chart and choose the best stop loss and take profit positions for this setup. Explanation. Excellent. Point 2 is the ideal stop loss because it's placed just below the recent high or low, protecting the trade if the trend fails to continue. Point 5 is a strong take-profit target, aligned with the previous major high and offering a good risk-reward ratio. Markets don't always move at the same pace. In high volatility conditions, tight stop losses often get hit before price moves in your favor. That's why smart traders adapt their stop loss distance based on volatility, not just price structure. When volatility is high, price moves are fast, and candles are large. If you set your stop loss order too close to the entry price, you risk being taken out by normal fluctuations. Indicators like the Bollinger Bands or moving averages can be used to guide placement. For example, in a bullish setup, you can place your stop loss just outside the lower Bollinger Band or below a rising moving average like the 20 EMA to allow for natural price swings. In a bearish setup, place your stop loss just above the upper Bollinger Band or slightly above a falling moving average like the 20 EMA to give the trade room during a pullback without exiting too early. When volatility is low, price is more stable and compressed within narrow ranges. In this environment, large moves are less likely, so tighter stops are more efficient. In low volatility bullish setups, traders use indicators like RSI or MACD for confirmation. If RSI holds above 50 or MACD stays above the signal line, a stop loss just below support limits risk without overreacting to minor price moves. In a bearish low volatility scenario, if RSI stays below 50 or MACD is below the signal line, a stop loss placed just above that resistance is appropriate. It's tight enough to protect capital if the trend fails, but gives the trade room to play out without being overly exposed. Select the match. Match the setup with the correct stop loss and signal. Match each scenario with the appropriate stop loss position and indicator behavior. RSI below 50. Stop above resistance. Bullish high volatility. RSI above 50. Stop below support. Bearish low volatility. Stop below Bollinger Band or EMA. Bullish low volatility. Stop. You've now seen how divergence isn't just for spotting entries. It's a key part of risk management. Up next, let's test what you've learned in a short quiz to check your knowledge.